In 2026, most people think growing wealth is about finding the best stock or a perfect high return investment. But the real difference between people who build lasting wealth and people who constantly restart is simple. A system beats a prediction. Let me explain it in a practical way. If you want to multiply your savings, you need two engines working together: banking discipline and investing compounding. Banking is where you control risk and protect momentum. Investing is where you compound over time. When those two are aligned, your money starts behaving like a machine. Step 1. Build the banking foundation so you never panic sell. Before you chase the market, set up a clean cash system. In 2026, this usually means separating cash into two jobs: safety, cash, emergency fund, and near-term bills; opportunity cash, money ready for dips or planned investing. This is why high-yield savings accounts and cash management features matter. The goal isn't to get rich from interest. The goal is to keep your investing plan stable when life happens. People lose money not because the market is evil, but because they're forced to sell at the worst time. Step 2. Invest like an owner, not a headline reader. If you keep checking stock market news today and S&P 500 outlook, it can feel like you must act every day. But news is not a strategy. In 2026, a stronger mindset is build positions over time, reduce fees, and stay invested. Most long-term wealth is built by consistent contributions, diversification, low friction, fees, taxes, unnecessary trading, and time in the market. The market rewards patience more often than it rewards urgency. Step 3. How to invest $50,000 for long-term wealth. If you're starting with $50,000, don't put it all into high-risk, high-return ideas. Split it into roles: cash buffer, so you never touch investments in an emergency; core long-term portfolio, the compounding engine; growth slice, higher volatility, smaller size; learning budget, small controlled exploration for trading. This structure protects you from your worst enemy, emotional decisions. Step 4. Choose the right brokerage like a serious investor. People compare Robinhood versus Fidelity versus Schwab, but the best platform isn't about hype. It's about what helps you make fewer mistakes. In 2026, the real checklist is reliability during volatility, strong research tools, clean order execution, low and transparent fees, excellent support, easy banking transfers, and automation. A brokerage is not an app. It's your long-term infrastructure. Step 5. Options. Trading for beginners. Use it carefully. Options can be useful, but they are not a shortcut. If you're a beginner, the rule is never enter a trade unless you can explain your maximum loss instantly. In wealth building, options should be a small slice of your plan, risk-defined, sized conservatively, and used for learning, not adrenaline. Step 6. Advanced wealth pathways when you're ready. As you grow, you'll hear about robo-advisors, wealth management, private equity, hedge funds, and accredited investor opportunities. These can be helpful, but they are not magic. They often come with trade-offs like fees, complexity, and illiquidity. The smart move is building a strong public market foundation first, then exploring alternatives as a diversified addition, not the core. The 2026 bottom line. If you want real wealth, stop searching for one winning move. Build a system: smart banking to protect momentum, disciplined investing for compounding low fees, and tax efficiency to keep more returns controlled risk. So one mistake doesn't erase years and a long-term mindset that survives volatility. In 2026, wealth isn't built by knowing what the market will do tomorrow. It's built by creating a financial structure that performs no matter what tomorrow brings.